Let me run you through quickly the background of the August numbers and what our thoughts are on what's happening in the marketplace. I think we're certainly seeing inflation continuing to climb. It's a gradual climb back upwards away from the 2% target the Fed has got. Um, the significant contributors from the upward trajectory are obviously gasoline prices, which is up nearly 7% month on month. Utilities is up significant amounts. And you're also seeing other vehicle costs that are up significantly versus month on month. And I'll go in a bit more detail a bit later on as to what's driving those. Then you have also things like housing, food, new vehicle or vehicle purchases that are applying a downward pressure on the inflation numbers. But I think net, we're starting to see inflation drop, or the rate of growth is slowing down. And we're seeing a month-to-month growth shifting from what we saw earlier in the year, nearly 1% month-to-month, as high as 0.8% month-to-month, to now being a 0.15% month-to-month growth. So definitely a slowdown, but it certainly is the direction in which the Fed was hoping inflation would not be going. Now, if you look at the last 6, 7, 8 months, you've seen some strong economic data coming out from the U.S. economy. The S&P is up 18% year to date. The 2-year, 10-year Treasury yields are at the highest level since June 2007. The inverted yield curve is closing. And all of this is despite all the aggressive rate hikes that we've seen in the last 18 to 20 months. So, that all that transfer definitely does show a continued positive momentum, but there are signs in the economy that we should be wary about. First of all, one of them is the labor market. There seems to be some hint of softening, less so in the unemployment rate numbers, which the government is reporting, which has increased from 3.5 to 3.8% in August. I think second of all, you're seeing, in our view, more importantly, you're seeing other data sets and other news that's suggesting that unemployment is probably increasing at a faster rate than what the government is reporting at. And that's natural because of the lag effect that's sitting in the government number. So we're seeing some increased softening in the labor market. This coupled with wage and salary increases slowing down. We saw the previous month wage and salary increasing at 6%, according to the BEA, and now it's running at 4.8%. And that's seen a gradual slowdown the last sort of 6 months as well. Beyond the labor softening, you're seeing consumer confidence, which, as you all know, is 2/3 of the U.S. economy is built on consumer expenditures. And the consumer spending is consumer confidence that fuels the consumer spending is certainly a big concern in the US, and that has dipped this month as Truflation has reported that out. And the dipping is a result of not only the rising prices that we're seeing, but I think also because of the labor market, where consumers are concerned across all age groups, but also more importantly, actually, we're seeing the biggest concern coming from the higher income groups. As a result of those two factors, the labor and the consumer confidence dropping, it's no surprise to see retail spending slowing. We moved from an 8.7% growth to a 2.5% growth. So it's definitely slowing. You take out the most recent month of 2.5% growth and take out the impact of inflation, it's actually virtually in negative territory. And then you're looking at housing prices, right? We're seeing that the housing sales slowing down, although the pricing is increasing, but the housing prices are slowing down. And we're certainly expecting to see a further cooling down of the housing market as well as we progress to the back end of the year. So I think net, what are we looking at from an inflationary standpoint? What does all that mean? Look, I think we're expecting to see the prices post-pandemic, where goods has been coming down post-pandemic, now to see a revival in the prices of goods, while services will remain sticky but less sticky. I think second of all, what we'll tend to see is to get to the 2% target that the Fed has been stating as their objective. According to Jerome Powell at the Jackson Hole meeting, they're expecting a full economic slowdown will be required to get that inflation number to under the 2%. The Atlanta Fed has announced, which is part of the FOMC meeting and the main core voting rights of the FOMC, is projecting a quarter three GDP forecast of 5 to 5.6%, which is significantly higher than what Q2 is, more than double what Q2 was. And that's certainly an optimistic viewpoint of what GDP growth will be in Truflation's viewpoint. And that will certainly add more pressure onto them. I think the third thing is then coreflation. Where is coreflation going to land versus non-core? And I think we're going to see, because of the increased trajectory of petrol and energy costs, you'll start to see non-core having an upward trajectory, and core holding relatively stable, a bit of an upward, but less so. The main driver is going to be in the non-core category. And I think the third thing to be wary about on inflation and what the outlook of that is for the longer term is that there is significant increased inventory in the marketplace, that's causing it will cause downward pressure on prices. Combine that with slowing demand, combine that with increased delinquency rates that we're seeing on people's expenditure on credit card, and therefore the impact it has on the consumer-based economy. I think we'll all shine right that we'll start to see some upward trajectory of the inflation, not only in August, but also in September, and most likely in October as well, before that number starts to trickle down again in the last months of the year. So that's a high-level synopsis. Again, the key drivers of upward trajectory of inflation this month, and they are overriding the downward trajectory, is gasoline, utilities, and other vehicle expenses. And then the downward pressures on inflation are basically owned housing. You got vehicle purchases and food, or some downward trajectory. Where does that all net us out on? We are expecting a Truflation that the BLS CPI number will come out at a further 0.2% increase from the previous month. So the last month was 3.2. We're expecting the CPI number to come in at 3.4% for this month. Our longer term trajectory is we're expecting the quarter to come out roughly around the 3.6% mark, and the end of the year to be in the range of 3.5% to 4% for the full year number.